So as tax season's nearing, I wanted to walk through an individual tax return as an example and point out 5 areas on the difference between a tax credit and a tax deduction, and then point out some tax deductions to make sure that you're not missing out on your personal tax return. First off here, we got a married couple. They have 2 children, and here's their W-2 and here's their income. So point number 1 is deductions. So what deductions do is they reduce your total income to arrive at the taxable income, which is going to be subject to tax. So you get your W-2 income. They had a single member LLC, a consulting business. So their total income was this. Then there's deductions, right? So we'll go through these deductions a little bit later. There's the standard deduction or itemized deduction. And typically if you own a home, you can take that mortgage interest and real estate taxes as a deduction. Now, depending on whether you're filing single, married joint, married separate, the standard deduction may be higher than your itemized deductions. But typically, if you're in that area where you own a home, you're paying real estate taxes, do the itemized deduction. In this case, if you want to go back to see whether you itemize or take the standard deduction, go back to your 2020 tax return and see if there's a Schedule A, because that's where the itemized deduction. And you'll take the higher of the two, the standard or the itemize. And for this couple, the itemize is higher. And you can see here, real estate taxes, payroll taxes. This section here is capped at $10,000, which there's a bill right now in Congress which may increase this. And there's also a tax loophole where if you own a business, some states have kind of come into this where you might be able to kind of get additional credit here. And we'll post that in another video. You can see here they paid $23,000 in mortgage interest. They donated $7,500 to charitable organizations during the year. So the sum of all those is $40,500, and that's going to help reduce their total income. And then there's the QBI deduction, which I'll cover later. So their total taxable income is $156,000, and this amount is used to calculate what the tax is. So that's point number 1 is deductions. Tax credit, point number 2, is better than a deduction because it reduces the amount of tax that you have to pay. So here's the total amount of tax that they have to pay, but wait, they got credits here. One of them is the child tax credit. They have 2 children. Their income is in a certain range, so they were able to kind of take this credit. And you can see there's some other credits here. So point number 1 was deductions. What are they? Point number 2 is tax credits. What are they? So whenever you hear tax credits, you always want to kind of be on alert because those are a lot better than tax deductions. But tax deductions are also great as well because they kind of help your total, kind of reduce your total income. So point number 3 I want to cover is, it's called the qualified business income tax deduction. If you own a business, you receive a K1 or even your Schedule C, your single member LLC or sole proprietor, make sure you're taking this deduction. So in this case, they own a consulting business and they're a single member LLC. Their total net income is $50,000. What this qualified business income tax deduction allows them is up to 20% of this amount as a deductible item. So in this case, they're allowed to deduct another almost $5,500. So that's called the qualified business income tax deduction. Another deduction that they get here, and it's going to arrive at, so that was number 3. Number 4 is the self-employment. So you can see here the total income here is $225,000. Then there's this other deductions of $22,536, and we'll go see what makes up that amount. And it's made up of 3 items. And one of them is self-employed health insurance. So if you're a business owner, you're paying health insurance premiums, that's a deduction. You want to make sure you take that and get credit for that. And then the last item is retirement accounts. So again, if you're self-employed, make sure that you set up a SEP plan, simple IRA, 401k, because whatever you contribute to that plan, in this case, he contributed about $9,900, that's a deduction. So it's not a tax credit, meaning you're not going to get a $1-for-$1 reduction in your tax bill, but it's going to help reduce your tax liability. So those are the 5 points I wanted to cover in this video. And then I guess one last point here, and we see this a lot, is your entity selection if you're owning a business. So in this case, Ferris owns a consulting business, and he just kind of set up a single member LLC, okay, which is fine. But what he's subject to is he's subject to self-employment tax, okay? So self-employment tax here for him, it is $1,300, okay? Now, if he was set up as an S-Corp, S-Corps don't have to pay self-employment tax. So he would save himself $1,300, $1,400 by just becoming an S-Corp. Now, being an S-Corp, it has its own separate set of rules. He's got to file a separate, business tax return. He can take distributions out of the S-Corp. There's a lot of, advantages in S-Corp. So just make sure when you set up a business that you make the right entity selection, because it will save you a bunch on taxes. Thanks.